$90,997. That number is important because it's the OAS, the Old Age Security Clawback for 2024. Now, Old Age Security is a government benefit to you based on how many years you were in Canada. So it's definitely something you want. If you were in Canada your whole life, it's a social benefit that all of us can get. But if you're over that number in 2024, you may not get all of it. So in this video, I want to break down how it works and how to make sure you get every single dollar available to you through the OAS benefit. A quick summary on Old Age Security. Now, Old Age Security is a social benefit that's paid to you. For every year that you're in Canada, you get a credit. Once you hit 40 years, you get full credit. Meaning that if you're in Canada after the age of 18 for 20 years, you get 50% of the maximum Old Age Security. If you're here for 30 years, you get 75%. And of course, if you're here for 40 years, you hit the maximum at 100% of Old Age Security. So for most of you watching this video, you're gonna get very close to or the full Old Age Security. Some of you that are newer to the country, be aware, you're not gonna get the maximum. You will get a discounted or a lower rate based on how many years you were here. Just to note, the maximum payment for 2024 is $707 per month. So again, if you're looking to start Old Age Security, you've been here your whole life, that's the number to expect. But again, Old Age Security is something that can be clawed back. Any amount that you make over that $90,997 in 2024, for every dollar over, your Old Age Security will be clawed back 15%. Now that may not seem like a lot, but as you earn more, more is clawed back. Again, that's not money in your pocket. That should be yours based on how many years you're in Canada. So it's really important to make sure you understand how much net income you had. And based on net income, they look at line 234. So look at your tax return, line 234, and let's make sure we're under that number. Now I'll get to a few ways to help avoid Old Age Security clawback and some tools and strategies that you can use in your retirement plan. But I want to use 2023 as an example. So let's say you retired at the beginning of 2024 and you thought, I'm gonna start my Old Age Security. I just turned 65. I wanna get that collection at $707 every single month into my bank account. But what they're gonna look at is last year's income. In fact, right now, they're gonna look at 2022 income, not 2023. So as of July 1st, 2024, they will look at your 2023 income. So just be aware, even though you're not working now, you don't have a high income, they will look at previous year's income. So if you made $100,000 last year in 2023 working full-time, and July 1st, you start your Old Age Security, just be aware that you're not gonna get the full amount. There is gonna be some clawback there potentially. There is a form you can fill out to say, look, things have changed, I'm not making as much. Maybe you had a one-time event like you sold a rental property that drove up your taxable income. There's a form. I've heard some horror stories on that. So I would just follow the simple rule of what did I make last year and 2 years ago, and just kind of follow that rule and map it out. So in the first half of the year, January to July, look at your income from 2 calendar years ago. So right now we're early in 2024. Look at 2022 income. That's the simplest way to do it. Yes, you can get more complicated than that, but for most of you, keep it simple. Look at 2 years ago. If you made a decent amount of money, then you may want to continue to delay Old Age Security. Now remember, if you delay Old Age Security, you get 0.6% every single month that you delay it past age 65. So there is a benefit. That's $707 per month that you receive. It keeps increasing for every month that you don't take it past your 65th birthday, all the way up to your 70th birthday. So you can have a nice benefit, a larger benefit, if you do delay it. So again, don't be, if you made 100 grand and I don't want to have clawback, there is a benefit to delay it. So again, there's a penalty to take it, benefit to delay it. Kind of a no-brainer there. So if you're coming up to 65 or you're 65 and older and haven't taken your Old Age Security yet and you're thinking about taking it, what are some strategies to help you avoid the OAS clawback to make sure that you get every single dollar of the Old Age Security? Now I'll say this, we've done some retirement plans for Canadians that they have so much income, they have full clawback or very large clawback. We do everything we can, our team, to help mitigate that clawback. But the reality is, some of you watching this video, you might have 2 really good defined benefit plans, you've saved really well, you just have a lot of taxable income. You might be single, unfortunately single because you can't split income. There's often more clawback there as well, unfortunately. But If you have a clawback and you've done everything that you can to avoid it and you still have clawback, it is what it is. You make too much money, it's unfortunate. But again, and we've also had some plans where we work to avoid clawback. We do avoid the clawback, but it's costly in other areas. So that's why if you feel like I'm up against clawback, there's a lot of moving parts, make sure you talk to your financial planner to get a plan in place. If you need help with that, reach out to our office. We do offer fee-for-service financial planning, parallelwealth.com/planning. We're happy to help you. So strategy number one to avoid the clawback, or at least reduce the clawback, would be income splitting with your spouse. And I go, this only applies obviously if you have a spouse or common law partner, but if you do, make sure that you're filing your tax returns together. You're claiming each other's income, because you can actually income split over, which for a lot of people in Canada, a lot of couples in Canada, that's going to help save one person from clawback. So make sure you income split. Not only is there tax benefits to income splitting, but things like the clawback could be absolutely avoided just based on kind of a paper transaction to save some of those taxes and get you your full OAS versus having some clawback. The second tip I have for you, and this is really the runway. I talk about like build a plan with a runway up to retirement. And this tip is to build up your tax-free savings account. And why a tax-free savings account is, in my opinion, the most important tool in retirement is it gives you full flexibility. If you need a little bit more income, so let's talk about your GoO phase of retirement, those first typically 10 to 15 years of retirement. You want more income, but we don't want to trigger more taxable income. A, we don't want to drive up the tax bill, and B, we don't want to have OAS clawback. So one way to do that is to kind of dip in when needed to your tax-free savings account. Again, you might max out your tax-free and have a non-reg, but your tax-free savings account, make sure you work to build that up. Try to max it out by the time you retire, and it'll give you so much more flexibility around income, taxes, OAS clawback, and many other things as you go through retirement. So don't overlook the tax-free savings account. And again, we just did a video on the importance of the tax-free savings account and using it as a investing account, not a savings account. If you missed that video, make sure to watch it, because it doesn't matter what your age is. I did a scenario with a 67-year-old couple, and by utilizing their tax-free savings account with conservative numbers, put $250,000 back in their pocket. So make sure you watch that video. We'll link that below. The third tip I have for you is contributing to your RRSP. And I'll give you an example, because this might be confusing. You said, Adam, like, why I'm retired, why would I put money into an RRSP? There's typically 1 year in retirement that this would make sense, and it's the year after you retire, or possibly the year you retire. So I'll give you an example. My dad just retired in October of 2023. Now, he was working full-time and had a nice income. Come 2024, now in January, what we've done, and we just had the conversation 2 days ago, is that we're going to pull money out of his RSP right now. So we're going to pull, I'll just use an example number, $20,000. So we're going to pull $20,000 out of his RSP, which is going to give him $20,000 of taxable income in 2024. Now, he's retired. He doesn't have any other income other than a few other small pensions. So we needed to draw. Part of his plan was to draw out a bit more than that out of his RRSP. But we're going to take that $20,000. There's going to be some withholding tax. He's going to top it back up with some cash he has to $20,000. We're going to put it back into his RRSP before the deadline of February 29th this year. So what happens is the $20,000 we pulled out is going to be taxable in 2024, the year where he doesn't have a lot of other income, he's in retirement, and it's part of his retirement income stream. The contribution of $20,000 is going to be credited for 2023, which is going to lower his income down, not only save him taxes, but get him below that OAS threshold limit. Now you might say, but Adam, now you've triggered $20,000 of income, but you don't have that cash because you put it back in your RSP. What's your dad going to live off of? That's where tip number 2 comes in. Build up that tax-free savings. Have non-reg. Have cash on the side. Have other tools. This isn't going to work for everyone, but it should work for a lot of you. So if you have RSP room, as you hit that kind of January, February of the year after you retire, you might want to consider topping up the RSP, taking some out of your RSP if you don't have the cash. A lot of people don't have the cash. Look, I want to top up the RSP. I don't have the cash. For my dad, it's a perfect example. He had the cash, but said, Dad, why don't we just pull out the RSP and put it back in? Basically churning your RSP in a legal way, saving you taxes from 2023, creating taxable income for 2024, which we need to do, and you're ahead on a $20,000 process like that. He's ahead about $3,000 to $4,000. So a nice tax benefit, gets him under that OAS clawback if he wants to start his old age security. He just turned 65 the other day. And so a great strategy there. So consider contributing to your RSP because it lowers your taxable income, again, gets that line 234 lower to avoid the old age security clawback. The fourth and final, and maybe the easiest way to avoid clawback, is to delay your old age security. If you run into a clawback situation, I would recommend you delay your old age security. Again, if you're someone that runs into OAS clawback, I would strongly recommend getting a proper retirement plan put together. I think everyone should have a retirement plan, but if you're someone that falls into clawback, it means you have good income, you have other assets coming in, you have a lot more moving parts typically. Make sure you get a proper plan in place to avoid the tax bill and avoid OAS clawback.